This is Mike Lingle from Rocket Pro Forma, and today we're going to talk about the three financial statements. We don't need to become accountants, but we do need to understand what the three financial statements are and how they fit together. So here they are. The first financial statement is the income statement. This is what we submit with our taxes. It is what we think of typically as the revenue, the expenses, the profit and loss. Second statement is the cash flow statement. And this is an accurate snapshot of the cash flowing into and out of the business. The income statement doesn't properly represent cash. We'll talk about that in a minute. And then the third statement is the balance sheet, which is kind of the net worth of the company. It lists the assets of the company, the liabilities of the company, and then the net worth of the company, which could be positive or negative. So those are the three financial statements. There is a related concept called cash and accrual accounting. And I do a separate video on that. Short story, accrual is more like credit cards where there's a lag between the transaction and the actual transfer of cash. And cash accounting works more like our wallets, right? We hand over the cash is gone. And it's an immediate transaction. So the income statement is on the accrual basis, which means it doesn't exactly match cash. I explained this in another video, whereas the cash flow statement is on the cash basis, which is cash. And startups live or die on cash, but governments and investors want to see the income statement first. So that creates a disconnect. And I actually got into a little bit of trouble with this early in my career, where I was using the income statement, leaning on the income statement more heavily than the cash flow statement. And there was a big discrepancy, and that got me into trouble. And it got my employees into trouble. And the balance sheet is also on the accrual basis. So we need the three financial statements in order to have a full picture of the company. But as entrepreneurs, we may only be looking at one of these and not getting that full picture. So that's part of what we want to do here, is just make sure we understand how the three financial statements fit together. And like I said, with cash and accrual, cash works more like our wallets. I pay for something, I hand over the cash, the transaction happens right then. With accrual, there's a lag. Someone asks for money and there's a delay before that money is actually transferred. And accrual happens all the time in business, and so does cash. So they're just tools. One's a hammer, one's a screwdriver. You can't do a construction project without both. It's not that you're picking one or the other, it's that you are going to end up using both in business. So these are the three financial statements. These are how they fit together. Let's do a little bit of a deeper dive. So the income statement, the first statement, is also called the profit and loss statement, or P&L, profit and loss for short. So keep that in mind. Income statement, profit and loss statement, P&L, they all mean the same thing. And it's typically on, the income statement is typically on the accrual basis. It doesn't show some important cash items like inventory, accounts receivable, and deferred revenue. I do another video with a deep dive into some of those things. It doesn't include the cash we take in when we raise money or borrow money. It doesn't include capital expenses, which are large expenses like office build-outs or large equipment purchases. And it may contain non-cash items like depreciation. So the income statement is great, we need it. We hand it into the government when we pay our taxes, but it is not a full picture of cash. And so financial projections start with the income statement. That's what we lead with when we're looking at the business and showing things to investors, but the income statement lies about cash. So we also need the cash flow statement, which is always on the cash basis. So it shows how much cash your company has, how much is coming in, how much is going out. It removes the non-cash items like depreciation or accounts payable. It includes the inventory expenses. So when you're pre-buying inventory, for example, it includes deferred revenue, and that is in a subscription or software as a service business. When people pay those annual subscriptions up front, that's a huge amount of cash coming into the business. But on the income statement, you don't show all of that income. It also includes the cash we raise from investors or borrow from loans or grants. If you get grants, that cash would show up on the cash flow statement, but not the income statement because it's not income. The cash flow statement includes the capital expenses, equipment, office build-outs, those kind of things. And so here's an example of what a cash flow statement looks like. So you start with how much cash you have in the bank. So in true startup fashion, we're at a negative number. Then you have cash flow from operating activities. Then you have cash flow from investing activities, which strangely is not, that's the term the accountants use, but that's not money raised from investors. And that gives you a cash position. I always like to calculate the cash position, including the financing activities. And then you have the cash flow from financing activities, which is the money coming in from the investors or loans or whatever you're doing to finance the business. So in this case, we're raising $500,000 from investors, and that puts us back in a positive number. We were down almost 190,000, and now we've plugged that hole with some investor money, and we have 311,000 to move forward and run the business. So yay, another startup is saved. All right, so that's what the cash flow looks like. And this cash flow from operating activities starts with the EBITDA that comes in from the income statement. So the statements are connected. And here's the way that works. So in the income statement, we have revenue coming in, we have cost of goods sold going out, we have a gross profit. Then we have operating expenses, paying to run the business, and that gives us an EBITDA number, which in this case is positive, right? Then we pay taxes on that money, or reserve money to pay taxes on that profit. And that gives us a net income, which in this case is a positive number. Now we carry that net income over to the cash flow statement. And we start with that number, and then we start subtracting non-cash items. So some of our 100,000 in revenue was accounts receivable, so 25,000 of that isn't actually cash. So we subtract that back out. But we're doing a subscription business, and we did take in some annual payments up front, so that's cash that's a positive. We purchased some inventory, so that's cash going out. We repaid a loan, so that's cash going out. And remember that repayment happens after tax. So the loan costs us the interest plus the tax, and then that leaves us actually our net income that was positive on the income statement has turned into a negative number on the cash flow statement. So just remember, the cash flow can be very different than the income statement, and that's why we need both. And that's why on the template that I've created and that Rocket Proforma creates for you automatically, the summary template, the pitch deck slide, I include the income statement, but also a little piece of the cash flow statement, because you really need to see both to understand the health of the business. The third financial statement is the balance sheet, which is typically on the accrual basis. It's a snapshot of what your company owns, which are called assets, and owes, which are called liabilities. And the assets have to match the liabilities plus the equity. I'll show you a diagram of that in a second. And the balance sheet gives you the net worth of your company. Similar to how you would, if you were calculating your own net worth, tally up your assets, subtract your liabilities and debts, and that would tell you your net worth. And so what a balance sheet looks like, you have assets in the first section, which is cash, maybe some assets that you own, like equipment, and that gives you a total number. And then liabilities and equity. So current liabilities, accounts payable, deferred revenue, loans, we have $46,000 in short-term liabilities, $50,000 in long-term liabilities, and assets have to equal liabilities plus equity. So 136,000 has to equal 136,000. So if our debts are 96,000, we actually have a positive shareholders' equity of $40,000. This $40,000 is not the same valuation of the company you would use to raise money with investors, but it does appear on the balance sheet as an estimate of the shareholders' equity. Now, little changes on the balance sheet can have big effects. So if we were to change the long-term liabilities, here we go from $50,000 in long-term liability to $100,000 in long-term liability, you will see that the shareholders' equity actually becomes negative. So, be careful with the liabilities because they can dramatically affect the shareholders' equity. These are the three financial statements: the income statement, also called the profit and loss, or P&L, the cash flow statement, and the balance sheet. Again, the income statement is on the accrual basis, the cash flow statement is on the cash basis, and the balance sheet is on the accrual basis. So that's it. I'm Mike Lingle from Rocket Proforma. Hopefully this helped feel free to watch this video another time just to get the hang of it. And again, inside Rocket Pro Forma, you will see on the pitch deck slide, it combines the income statement and the cash flow statement. And then you will also find in Rocket Pro Forma an income statement, a full cash flow statement, a full balance sheet. So check it out.